Hi, this is Dr. Sue Cooper with a video doing Chapter 12 homework for Managerial Accounting 321 at University of Maryland. This is our last video for this chapter. We're going to be looking at homework problems 11 and 12. Okay, so 11 says, assume you are about to sell property, a vacant parcel of real estate you own, but otherwise have no use for. The net of sales commission selling price for the property is $450,000. So that's how much you're going to get paid. Regardless, that's like after all the money is over and done, you've paid all your commissions, you're going to get $450,000. Well, that's not right. 450,000. Okay. And I've got these totals here across the top because it's going to ask me to do 4 different scenarios. If I get paid every week, paid every month, paid every quarter, paid every year. You'll see in a minute here. Okay, you're willing to finance the transaction over a 22-year period. Wow, so you're going to hold the loan for the person who's buying it from you. So it's going to be 22 years, and whether they pay you every week, month, year, quarter, it doesn't matter. It's still going to be 22 years. And you've told the buyer you expect pre-tax return of 13%. All right. The buyer has asked you for a payment schedule under several alternatives. Okay, what will be your total cash receipts to earn a 13% return if payments are received from the purchaser at the end of each week, end of each month, end of each quarter, end of each year? It's a little bit confusing because they should put these up here above this note, but they messed up. So this part needs to go down below the ABCD. It was so confusing when I read it the first time. So use the payment function in Excel to calculate payment. Okay, I'll show you that. What is the total cash receipts over a 22-year period for each of the 4 situations? Payment at the end of each week, month, quarter, and year. Okay, very cool. So these are the payment frequencies. So how many payments will we get if they pay us every single week? All right, so if they pay us every single week, then the number of payments we'll get is equal to 52 weeks in a year times 22 years. Okay, if they pay us every month, it'll be 12 months a year times 22 years. If they pay us every quarter, it'll be 4 payments a year times 22 years. And if they pay us every year, it'll be 22 payments. Okay, and then this is interest per period. So the interest per period, it's 13%. And we need to divide that, that's per year, so we divide that by 52 weeks in a year. These need to be percents. Okay, and this one is 13% per year, and we got to divide it by 12 months in a year. This one, 13% divided by 4 quarters, and this one will just be 13. Okay, so on the table, we need to use these. The NPER is number of periods, and you could just do like a lowercase n, and then this would be your I, the interest for each of those periods. All right, very good. The present value right now is $450,000 for each of these, and the future value for each of these is 0. They're gonna pay us off. They pay the loan off all the way. How much will the payment be under these scenarios? So a total of 1,000 payments, 260 payments, 88 payments, or 22 payments. Okay, so PMT is the Excel formula that will calculate the number of payments we have. Or I'm sorry, it will calculate the amount of the payment given the number of payments and the interest rate and the present value. So rate is your I. Number of periods, that's how many payments there are. Present value is this, and future value is that. And we need to make the present value negative. Okay, this is our payment amount. So that's it right there. Boop, boop. And we can go all the way across. Okay, cool. That's how much our payments are. So periodic cash receipt, if they pay every week, they'll have to pay $1,194 a week. That feels really high. Oh, I'm sure it's right. Okay. 5176 every month. 15,557 if they pay every quarter, and 62,766 if they pay every year. And then how much will we get in total over the 22-year period? Well, total. Okay, so we'll get, oops. So we'll get that much times that many payments. $1 million. These are all really high, aren't they? Oh, they're all pretty much the same. 1,365, 479. I better double check that. Make sure I'm not leading you astray. Oh, good. 1,366, 469. 1,369, 053. And 1,388.47. Okay, that's how much it'll be. So since they're borrowing the money to buy this land at a high rate, 13%, it's actually going to cost them like triple that to actually buy the property from us. Oh, right. Next one. Number 12, Rockyford Company must replace some machinery that has zero book value and a current market value of $1,400. Let me make a new spreadsheet so I can keep track of the information. Okay, so the net book value right now is 0. And the fair market value, FMV, is $1,400. The new machinery will cost $43,000. Produce an estimated annual pre-tax operating savings of $17,200 every year. Assume the new machine will have a useful life of 4 years and depreciation of $10,700 each year for book purposes. It will have no salvage value at the end of 4 years. The investment of this in this new machinery would require an additional investment of working capital. So working capital, we would have to do $2,200. Assume that when the old machine was purchased, the incremental net working capital required at the time was 0. So we don't have any working capital that's coming back to us when we retire the old machine. If Rockyford accepts this investment proposal, the disposal of the old machinery and the investment of the new one will occur on December 31st. The cash flows from the investment are expected to occur over a 4-year period. Rockyford is subject to a 40% income tax rate for all ordinary income and capital gains, and has a 9% weighted average cost of capital. after tax cost of capital. All operating and tax cash flows are assumed to occur at year end. Okay, so let me set this up just a little bit. So this is old net book value and old fair market value. All right, so I want to set up year 0, year 1, year 2. I'm going to do actually year 1 through 4, and then a year 4 for the disposal. Okay, so in the current year, we can dispose of the old machinery and get $1,400 and buy the new machinery. Disposing the old net book value doesn't matter. There's no gain or loss on that. Oh, yeah, it is. That means we have to pay taxes on that gain because look, the old net book value is 0 and the fair market value is 14. So this is gain on the old machinery. So we will have to pay taxes on that. So insert tax on old machinery will be equal to that times the tax rate. Okay, new machinery. So we've got all these. Every year we'll save 17,200. We got the life of 4 years. That's fine. Okay, the depreciation tax benefit every year will be equal to 10,750 times 40%. There is no salvage on the new machine. So we're not going to get anything back on it. We will have to put in working capital, which we will get back in year 4. Okay. So there's the depreciation tax benefit, but we are going to have to pay tax on the savings. So that'll be equal to that times the tax rate, 40%. Okay, I think I got everything sorted there. All right, so this is the total cash flows. Add all these. Okay, super. Determine the after-tax cash flow arising from disposal of the old machinery. Okay, so we'll get $1,400 for the old machinery, which will all be taxable because we don't have any net book value. So that will be a gain. So that means we have to add those two together. So the net of those two is $840. All right, very good. All right, required 2. Determine the present value of the after-tax cash flows for the next 4 years, attributable to cash operating savings. Okay, so it's just these two right here. Okay, so those two are $10,320. All right, so let's do present value of just those two. So the present value, the rate we're going to use is the weighted average cost of capital. Number of periods is 4 years. We're going to get those amounts every year for 4 years. And the payment is going to be that plus that. That's how much we're going to get every year for 4 years. And I always forget to make it negative. 33,434. That's the present value of just those two. All right, excellent. Present value of savings. Present value of gain. It's just these. And since it's year 0, I don't have to do the present value formula. That was for A. Oops. There we go. So this is A, that's B. And this one, it's just those two, the gain on the old machine plus the minus the tax. And then for the savings, I did the present value at the weighted average cost of capital for all 4 years, years 1, 2, 3, and 4. I'm going to get this much, the savings minus the taxes on the savings, future value 0. Okay, 3. Determine the net present value of the tax shield effect of depreciation for year 1. Okay, so this present value of depreciation tax benefit in just year 1. Okay, very weird. So that is equal to, wait, number of periods, just year 1 it said, and that's the benefit, future value 0. 3945. And I always forget to change the sign. Okay, check that one. Very good. And the last one, oh, nice. Which of the following is the proper treatment for the additional 2,200 of net working capital required for the current year? Okay, it should be a cash outflow for year 0 and a cash inflow for year 4. There's no taxes on working capital. It should be ignored. No. It is a sunk cost. No. It should be treated as a part of the initial investment. Yes. It should be spread over the machinery's 4-year life. No. It should be included as a part of the new machine and depreciated. No. Okay, very good. That's it. All done with the homework for chapter 12.